right. Happy hump day and welcome out to our show here today on a Wednesday, 8/18/2021. We've got a full panel of coaches here, and it is our show we call the Halftime Report on our YouTube channel at Tackle Trading. We're going to go through the markets one step at a time, break down what's going on across the board, including stocks, commodities, some individual companies. We got Target and Lowe's who reported earnings over the last 24 hours. Take a look at some of those retailers. It's been the week for retail names, Tyler. You know, we had Walmart, we had Home Depot earlier in the week and so on and so forth. So we're going to take a look at those, see what's going on with them technically from their earnings reports. We're also going to take a deeper dive into a bull call spread strategy with Coach Tyler during our weekly segment we call Jedi Options. And let's bring the coaches in here one at a time. Tyler, you first. How are you doing today, sir?
Better than the Russell 2000 index, Timmy.
Been stuck in a mud. It's trying to find that 200 though. You know, it's not
Let's
all
hope
bad.
it sticks the landing.
Yeah.
Right? Let's hope it sticks the landing. We'll see.
It's got really strong long-term support, the 200 period moving average. I kind of like the rut down here actually, but more longer term. Matt, how you doing today, sir?
So Tyler's doing better than the Russell 2000. Hey, come on, a support bounce off the 200-day moving average, finding a little bit of support. You got to be a little excited for that support bounce. Better hold though, right? One of those scenarios, better hold. No, I think I'm doing slightly better than the Russell 2000 as well. So I'm doing good.
Good deal. Well, let's get into the market, guys. It's kind of a light day in terms of the news. It's also a light day in terms of price action right now. It's the middle of August, middle of a Wednesday. We're waiting on the Fed meeting minutes that are going to be released at 2 o'clock here in about an hour and a half. Here we are, Tyler, you know, still a very healthy longer term trend. What did you read here on the marketplace?
Yeah, I think yesterday was a little bit of a shakeup. I think it could have been a lot worse. We had a nice bounce off the 20 yesterday, a little inside bar today. I still think the S&P is not doing this justice. You are seeing some weakness underneath the surface, as kind of manifest or suggested by the Russell 2000 index. But look, I'm bored. I don't know. I mean, just thinking about you asking me about today and this little dinky candle, I'm like, dude, I don't even know. Go to sleep, come back tomorrow, see what's going on. It's kind of a dull day. And we're in the middle of August, so maybe appropriate for this time of year.
Well, you know, and the S&P 500 here, obviously, as you're looking at the chart, Matt and I were talking about it yesterday. During the month of March, we had a pullback. During the month of May, we had a pullback. Middle of June, we had a pullback. Yep. Middle of July, we had a pullback. So here we are in August. I don't think it would shock anybody if we did have a deeper pullback, but we are holding on to that more aggressive trend line as of right now. So you got a little testing point here, Tyler. Where are those key lines in the sand for traders to watch? Because even on a doji hump day, right, we're all trying to map this out in our head. Okay, what do I need to pay attention to? Is it the 9 EMA? Is there an intraday level that you're watching? What are you going to be watching for technically here?
I think yesterday's low is the key level for me. I think anything above yesterday's low is just noise for me. So yesterday's low was where buyers said, you know, forget this, bears, screw you guys. Like, that's it. We're done. 20 MA. We're sticking the landing. If you stay above that, fine. You break below it. Yeah, I ain't happy. Maybe you're going to go back and test the 50 MA. So I think yesterday's low is the level for me.
Matt, what is your read on the markets here today?
Yeah, it's similar. I mean, you got a little bit of a doji Wednesday, but again, this isn't the first time we've had a doji Wednesday, so it's kind of par for the course in recent market history. But following yesterday's fairly quick sell-off, you want to see a little bit of stabilization. And yeah, you know, kind of like we said on the Russell 2000, better hold. And no, I do not think it would surprise anybody that if we saw a little bit of a deeper correction here. You don't really have a theme that is attracting a herd of buyers. You got mixed economic data right now. You got just a consumer sentiment situation that is, I don't want to say dire at all, but it is concerning in the short term to see such a dramatic decrease in consumer sentiment, which has been One of the backbones of the market over the last 10 years has been the strength of the consumer. And so I don't think you can just bypass the negative reactions the consumers have had during this increase in inflationary conversation over the last couple months. And so that's obviously concerning. When you look at the Chinese situation and the increasing regulatory measures that they're having in seemingly a different industry every other week, that's concerning. And so, and then you're seeing all of this concern in the scenario where we're talking about a Fed tapering and a reduction of the monetary support that the central bank is providing the marketplace over the last year with $120 billion plus in QE. All of those conversations are being had while the market is still consistently performing from a bullish perspective, and you're in the middle of the summer.
Mhm.
So it's just one of those moments in time where there's a little bit of lull in the market right now. And again, some of this is because of we're simply in the summer and participation has been down across the board for the most part during the summer. So you really don't want any massive hot takes there. But there are reasons to be concerned. Yes. But to answer the question in terms of the level that you would get concerned technically, Tyler, you said the low of yesterday. When you look at the futures chart on the /ES, yeah, I would agree with that. You can look at the S&P 500 SPY at the low of the day, or you can look at that 4,400 to 4,410 level. That's kind of where I'm looking at technically. 4,410 was kind of the low of the day. 4,400 is right in that significant whole number in chop, but that does coincide with Tyler's low of the day on the SPY. And so, yeah, I think that would be the data point to where you're like, yep, look out 50-day moving average.
Yeah, there's a little bit of a confluence.
Nothing
right
deeper
there.
than that, right?
No.
Nothing deeper than that. Nothing crazy, but that's where you would start really looking at, all right, a little bit of a deeper retracement here, in my opinion.
Mm-hmm. And the one event here, obviously today, everybody's waiting on Matt. We were talking about it pre-production is the FOMC minutes. It happens 3 weeks after every time the Fed has their policy meeting, we get the minutes released, right? The policy meetings are the ones that we get all geeked up about, worked up about. It's new content, new things. We were waiting for signals from the Fed. Minutes are kind of just a recap of that. And we've had a lot of Fed chatter since last meeting as well. Fed speech after Fed speech after Fed speech. I feel like I've got a pretty good idea on where the Fed's head at is right now. Do you think this meeting minutes today, it could be a market mover? I mean,
I don't. I know there's people out there reporting that this certainly could be a market mover, but the Fed minutes from 3 weeks ago, with all the conversations the Fed has given us in the last 3 weeks, and now we got a fairly decent understanding of the timeline towards tapering. I'm not sure that the Fed minutes from 3 weeks ago can add commentary on that, especially on the backs of what New Zealand did yesterday. The Fed has been very clear that they are data driven, and that even Jay Powell said yesterday that the Delta variant in concern with COVID has some concerning economic dark clouds, and that having a little bit more time to see where that specifically is important from a monetary policy perspective. And again, we are not New Zealand, but I do think what New Zealand did, shelving their 0.25% interest rate increase, which was going to be the first major central bank post-pandemic to see an interest rate hike in the faces of what could be damning levels of inflation across the board for a lot of countries around the world. They were going to look to increase, their interest rate 0.25%. And yet they shelved that due to one case of COVID. Now, that case out of Auckland, you're talking about a country with 5 million people with a vaccination rate of 5% right now. So it's not exactly an apples to apples comparison, but it does show you the sensitivity that central bankers around the world have to this conversation. And so, yeah, they're still data driven, but I do believe we have a fairly decent understanding of the timeline. I think we have a fairly decent, and as I mean market participants, I think we have a fairly decent understanding of exactly where the head's at from a tapering perspective. And so I'm not sure the Fed minutes can add to that conversation. Could it be a little fuel on the fire if the market's already moving? Certainly, but
Always,
I would say that about any economic report, though.
That's right. I mean, the fact that it's just on the calendar is really the thing that we're aware of.
Yeah,
Right? It's not really about what they're going to say here
well,
today, in my personal
it's
opinion.
it's kind of like your Google Calendar. It's
That's right.
just it's on there. It has a code. We have to look at it. That's it. But no, again. I would not give it any more relevancy against any other mid-level economic report.
Well, and the other thing is, remember, guys, next week they're going to be meeting in Jackson Hole with a lot new information and
That's the
messaging
one.
and all that kind of stuff.
That's the hot take mania.
Yeah.
Hell, we'll even have hot takes coming
sure
out of
we
that
will.
one.
I'm going to have a few.
Guaranteed.
I'm gonna have a
Guaranteed.
few.
But not on the Fed minutes, no.
I gotcha. All right, let's keep flashing through the market here technically then, Tyler. For me, the S&P and the Dow are all very, very similar, but just give me a read on what you're seeing across the board from an index perspective.
Yeah, as far as the Dow goes, I would agree. Not much different on this versus the S&P. I think it's worth mentioning though that it's not illogical where we bounced yesterday on the Dow. You were at the 20, you were at old resistance, became support. I think that's why it's hard to get overly bearish, right? Like a shaking of the trees for one day that takes you to a support level that holds. You haven't exactly like freaked people out. You take out yesterday's low, then we'll talk. But again, if we were talking midday yesterday when the market was at the low of the day, I think you'd be pretty happy today based on how the market stabilized. So that's my take on the Dow. NASDAQ, sluggish, man. Momentum just lost on this bad boy for now. Now, maybe deserve it. I mean, it's up a lot. Quite frankly, all the indexes are up a lot. So if I'm, as I am want to do, if I am the index and you're complaining to me, I'm like, what? I'm up 20%. Okay. Like, chill out. Give me 2 weeks, please. It's sideways. It's sideways. I mean, did it make sense to really change anything major on your outlook over the last 2 weeks, given what one candle did? No. Momentum is slowed. It's going sideways, but from a trending perspective, I mean, we're cheating below the 20 MA a little bit. It just goes back to what Matt said. There's just no theme. There's no umph behind this right now. So wake me up when it breaks the high. For now, it's just chopping sideways.
Yeah, and I don't want to make much ado about nothing. And I agree, it's probably just a patience and chalk. But is that a change of momentum and character? Or is that just a high base that you like more because it's taken some time off? I think that's an open question for me, Matt. We are now below a moving average for the first time in a while.
Yeah, you are below a moving average for the first time, but moving averages are more relevant in trending conditions. Mm-hmm. When you're looking at the NASDAQ right now, you're seeing a little bit more prolonged base. You could call that a little bit of a continuation pattern. And if it is a continuation pattern, a lot of times those take some time and moving averages become less important as it further goes into the pattern, because at some point you start seeing it as neutrality instead of just a bullish continuation pattern. And so I'm not too concerned with the NASDAQ getting underneath the 20. I see this more as a continuation pattern where you could see some chop sideways. I still think the breakout is aligned. And, if the breakout does occur, it's got to be traded. 100%, it's got to be traded. And I've seen a lot of chatter recently about, the concerns building in the market, or perhaps a drop in price, 5-10%. And certainly that could happen. There's no doubt about that. There's rich history in the month of September of market volatility happening. And so nobody would be surprised. But when you look at the market over the course of the last just few days, right, and especially in the backs of the volatility that we did see yesterday, when you look at the sectors, do you really have a change in bias in any sector that you were not already changing the bias coming into the week?
Maybe discretionary, but we were already
no. We were already
Yep.
changing discretionary. We had already went to neutrality and discretionary. Mm-hmm. And so I don't think discretion. I don't even think yesterday changed discretionary, since that was updated last Friday. Mm-hmm. When you're looking at when you look at, say, we were looking at the NASDAQ, you still look at, say, the growth areas of the market. Tech's still hovering the 20-day moving average. It's still kissing it off against that breakout channel. When you're looking at comms Comms hasn't done anything in the last week to change the bias. It's just a little bit here, a little bit there, a little bit nothing, nothing out there. But there hasn't been great trades in comms in the last couple weeks either, I would suggest. When we were in the scanner report meeting on Friday, we went through this entire sector. There's not a lot of stocks in this sector right now that are great, tradable instruments. And then when you look at discretionary, we talked about the problems with the discretionary sector. It's got multiple downgrades at tackle trading over the last couple weeks. It violated 180, the pivot point. It went underneath the 50-day moving average. All of those are very, very concerning. And you're talking about discretionary, which is in the face of some very, very concerning consumer sentiment reports. And so you got some very challenging environments in discretionary. There is no doubt about that. And but again, even before we saw some of those latest consumer sentiment reports, you saw slowing momentum. It could not break out any direction here. You saw the violation on Monday, but again, tackle downgraded this last week and downgraded the week before. And so you're just seeing the story play out over time here, but this story starts with the slowing momentum from 3 weeks ago. And so, yeah, there's some concerning information, data, economics here. This is, I don't know if I would say it is stay away because there's still good trades in discretionary, but it's not something you're going to get a lot of support from a sector perspective, if that makes sense. So outside of discretionary, when you go down the board in energy, the only thing energy did was not break out. It really didn't change the trend. It really didn't even change the dynamic of the pattern. It just didn't break out of that right shoulder. And so you're not really updating anything there. But where I do think these pullbacks can lead to opportunity, though, is while everybody's freaking out, go look at the financial sector. Look at XLF, pop, break out of multiple different daily and weekly resistance levels. And then what's it doing over the last 3 days as the market seemingly gets the doldrums of the summer and starts overreacting to every news story? It sits there and forms up a support level right there on the 9 EMA, right there on that 38 handle. That looks pretty decent. Tyler was talking about industrial with the Dow Jones earlier. That broke out of an all-time high at 35,000 and dinged an all-time high just last week, and now is forming a bull flag pattern where it's testing the old resistance level. Why is anybody freaking out over that pattern? That's a good technical pattern. That's a retest. Now, if it doesn't hold, yeah, that's where the concern is. But don't you have that concern in every support test?
Yeah, support's got to hold.
Yeah. And so when I'm looking at the market yesterday, I see a market that's giving us an opportunity in these areas that popped and run from last week, giving us a little bit of a reset. Yeah, we got concerned. We didn't get the breakout in energy. That sucks. We'll wait another couple weeks on that one. But the only sector that I would say has an increase in risk right now is discretionary.
Yeah, I have the same read on it as well. And I'm glad we went through all those different sectors. I think it always paints the picture in a very, very good way. Tyler, anything you want to add to sector analysis or index analysis?
And the increased risk comment is in relationship to last week to this week from a technical perspective.
And for me, also the economic data we've been seeing about consumers as well, specifically retailers.
Yeah, like typically in the middle of when you're in the middle of a market that is at the bottom of a market cycle, and the entire conversation is on monetary and fiscal support, economic reports take a back seat to that discussion. There's no doubt about that. Nobody cares about the economic reports when we're talking about pumping trillions upon trillions upon trillions of dollars into the marketplace. That's the only conversation anybody cares about in those Keynesian economic moments where we stimulate the marketplace. But as that starts to dissipate over time, and we start getting into more mid-level recovery analysis from an economic perspective, economic reports start to bring on a greater level of importance. That's what we're starting to see with the consumer sentiment report.
Yeah, appreciate all the thoughts and analysis on that, Matt. I think it does really sum it up very, very nicely in terms of where we are here today. Tyler, you got anything that you're seeing differently, though? I mean, anything that you want to reiterate?
No, I mean, if you the deterioration in the market is easier to see this week in the Russell. I understand the intermediate trend hasn't changed, but it had a chance of breaking out, kind of like the energy chart. Sucks that it didn't break out. It just pushes it off. Actually, I'll just echo exactly what Matt said. It just pushes off an eventual breakout, hopefully. But yeah, now you're getting the first test of the 200 MA in a long while. You probably don't want to see this take out the 200 MA. It's going to look pretty ugly at that point. You'll have a big topping pattern. It ain't going to be pretty if this thing takes out, 2100. So don't do it, Russell. That's what we're saying. Don't do it.
It's got a big test. It needs to hold, but I do actually like it maybe even more the next time it takes a fire resistance.
And honestly, I love the top-down approach to the market, but Tyler's 100% right. When you're looking at the S&P right now, it is not the best understanding of what is actually happening in the broad market right now. I do think the Russell 2000 and the weekly performance last week of the Russell 2000 is a better reflection of the volatility that the market is actually having,
especially in individual names. I think a lot of people out there are feeling that way.
Well, and especially in the individual, very popular trading names.
Most of the positions I have don't look like the S&P.
Yep. 100%. It's a better reflection of the actual trading community type names that are traded.
Yeah, everything's kind of been fading here for a few days. All right, let's flash through the commodity market next here.
That's why Apple and Microsoft are so stinking important.
Yeah, that's right. And there's
it really is.
They're lined up still, by the way.
Yeah. I mean, all those indexes, all those 401ks, all those IRAs, just write a thank you letter to Apple and Microsoft.
They probably just buy their products, which is why they're a $2 trillion company.
That's why it works for all of us.
That's right. That's exactly right. All right, commodities next here, Ty.
Oh, I had a too big to fail joke.
Oh, sorry.
No, we're good.
We're good. How big?
It was hilarious. It was funny. Yeah, like just let your imagination
stepped on your laugh, but you got one anyway out of me. So
and it was 100% clean. Tim went dirty somewhere, but it was 100. No, I kid.
Not
Move
Tim.
on.
Not
Move
ever
on.
Tim. No way. No way. Crude oil next here, Tyler. Test and support 65 is there. We are actually dialing up kind of in an inverted cup and handle situation, but as long as we're in the box analysis is going to play. But I think everybody's kind of been looking at this a little bit closer the last 4 days and 5 days as these red bars are firing down at it. Tyler, what you read here on this support test?
I mean, isn't this kind of the byproduct of the fear that the Delta variant's going to slow things down a little bit?
Maybe. I don't know if I buy into that yet, by the way. Maybe. I know those headlines have been everywhere for quite some time, and it could easily be bleeding into it, whatnot. But I think that there's just this.
Can I ask a question, Tim? Is the evidence building on that, though?
It is increasing, and the increasing risk you're seeing it in the consumer sentiment reports is one of the reasons people cited as to why they're less optimistic about economic outcomes in the future. They're worried about Delta variant, potential lockdowns, and all that kind of stuff. I just have a hard time relating it to crude directly over the longer term because I've been seeing that data for 2 or 3 months, and maybe it's that the market was just slow to wake up to it. I don't know, Matt. What are your thoughts?
Well, for a very long time, the market has not cared about COVID. Agreed?
Yeah, they didn't care even in the face of some of this disturbing data.
And I'm going back to last year, right? The market, do you guys remember when the entire market, including us, was reporting on death counts on a daily basis?
It was crazy to even think.
It was insane. It was insane, but that's how crazy it was. But from about March on, the market stopped caring about that. It stopped caring because they knew it was a longer term issue, right? And I remember bringing on Pete Thomas onto the podcast back when it was really getting hot and heavy. And he said, yeah, if we get 100,000 death count, this is where it gets concerning. And that was when we were like 22,000 death count. That's how early it was in the pandemic. But the market hasn't cared about it really since those early conversations as the market started embracing more of the fiscal conversation and the monetary stimulus conversations. Once the market accepted the fact that this was an ongoing situation that was not going to have a short-term solution to it, they started embracing the longer-term viewpoint of it. Well, now that that monetary stimulus is running dry, not just here in the United States, but from around the world, and now that we are talking about macro type themes of increasing interest rates, reducing exposure to the monetary and fiscal stimulus to the market. And again, it's not just here in the US, it literally is around the world. Do you feel that these COVID type concerning headlines, does it become more of part of the analysis? Is it more in right in front of us as market participants, and does it have a greater impact as the central banks around the world take a back seat? I do think there is some interesting conversations that should be had on that topic. And so, yeah, I do think the evidence is building a little bit more that the market cares about COVID. But at this point, I still believe the most important conversation the market is having is monetary and fiscal stimulus. That's just, you're in this transitionary period where I have seen data be more concerning to the market than in recent history. You're on mute, bro. Go ahead, Tyler.
I sure am. Go ahead, Ty.
Yeah. So I'm just bringing it up because I feel like this is anecdotal, right? I mean, I don't know. Maybe the lens by which I view things is unique, but I get my information from the same place everybody else does. So
yeah,
right. So it's like, I don't know. I mean, obviously something is weighing on crude oil, and this is a little more economically sensitive. I think it goes along with what you're seeing in copper, what you're seeing in the Russell. Those tend to be more economically sensitive. It just, there's just not, if there's a catalyst, it's not positive, right? Like if there's an obvious catalyst to point to right now for stocks, it's not positive, it's negative. And until that gets out of the way, or until the market decides it doesn't care anymore, maybe that hangs over its head for a spell.
And Tyler, you're absolutely right. Oil, copper, those are very, very economically sensitive, and not just to U.S. economic policy, but to international economic policy. Copper analysis does not start in the U.S. Copper analysis starts in China. That's where you start your copper analysis. So you're 100% right. And again, it's New Zealand, and I don't think New Zealand is the poster child and case study for how the world has handled COVID, but one case of COVID and they shut it down. I mean, literally shut it down. Central banks stopped the interest rate hike. And so could that have a bigger impact as we start to see this around the world? And can these economically sensitive instruments like oil and copper, can they continue to price appreciate in the face of that? That's concerning. And then when you look at oil specifically, this could violate 65 very, very easily, much more easily this time than it had than the previous last two attempts, because of the distance you're coming into and the lack of theme you have to support any type of buy at 65. And so, like, again, you're sitting at 65. It's a known support level. It's been drilled multiple times. It has succeeded multiple times. Everybody and their dog knows it. You can go out and buy crude oil, $65 right now. Who's going to do it?
You're not buying it here. There's no trade here. It's not a good probability play right here.
But to answer the honest question, though, it's not just because of the technicals going into 65. It's also exactly what Tyler's saying. Tyler, and Tyler, I don't want to put words in your mouth, but like, we haven't talked COVID a lot over the last year regarding any of our financial products. Like, Tyler very rarely brings up that conversation. We're talking about a master technician who lives on charts. And yet in the back of his mind, because of the conversations everybody is having at Seeking Alpha, Market Watch, CNBC, and every other, financial news organization, all of a sudden it's in our mind. And now all of a sudden we're seeing it on the chart. And it's like, okay, chicken and egg, but no, you have a lack of theme concerning economic data and a momentum coming into 65. Like, this isn't a Russell 2000. Oh, you better hold. This is a watch out below under 65. Now, I think 60, we're going to have a different conversation at $60 than we will at 65. I promise you that. But that's because of that 200-day moving average.
Well, and ultimately, I mean, the world's not going to end, right? Like, eventually we get over this. The silver lining is, if you think we eventually go higher, this is an opportunity, I think, in a lot of these names, right, that are getting beat up. It's not a matter of if, it's a matter of when.
I don't have the same overriding concern on energy stocks that I do on crude oil itself. Energy stocks are sensitive to crude sensitive to economic analysis, COVID, all that stuff that we've been discussing. Energy stocks have had amazing earnings reports. The underlying fundamentals of the energy argument are actually solidifying themselves, not weakening, in my opinion.
I agree with that 100%. I'm even thinking through this over the last couple of weeks, even at 60. I mean, crude breaks down, it's going to drag energy stocks lower in the short term, most likely. And the probability on the chart is looking likely that it will break down. It hasn't done it yet. I know support is support until it breaks, but man, we've got lower pivots, we've got pressure, all that kind of stuff. Sentiment has changed. But even at $60 a barrel, these energy companies, we went through those earnings reports during the quarter. They were very, very strong. Those are still very sound fundamentals. They've shifted their balance sheets. I like them.
Exxon didn't cut when they had negative oil prices. They ain't cutting at 60.
No,
we're good.
I think they're attractive.
They are. And they've had a long road to travel, right? But we're talking about this being the time that they start getting back to being profitable.
Yeah.
Right. That's a positive thing, in my opinion, not a negative. Short-term bump, no doubt about that. Short-term bump, got to navigate it. But the concern technically I have on oil, and I think Tyler shares on oil, is not shared in the energy space from a longer-term perspective, correct?
Yeah.
There are two things I have, and then I'm done on oil. So the first thing is, what's nice about oil is if you want to pull back 20-30%, that's fine. Just go to $77 before you do it, right? Like this would be a different story if it ripped to 50 and then dropped to 40 or 35 or something.
Oh, 100%, Tyler. 100%, because all of a sudden, fundamentally, we're talking about the average price of oil at 42 over the last quarter instead of the average price of oil at 62 over the last quarter. At 62, energy companies are throwing parties. At 42, they're cutting people.
Correct.
Yeah. So then the second thing is, again, a silver lining. If as XLE gets cheaper, and if it does, this still has a very beefy dividend yield. The yield 3.3%, way higher than most other sectors. So at some point, that gets more attractive compared to a lot of the other sectors that are at record highs. This is still well off the highs. Yeah. So bullish case, I think, is still firm there.
That's a good point. I think we're all looking at energy over the long term as well. All right, short term, potentially a bump here. We're going to watch support, but let's keep moving through the markets. Gold next. Bear retracement is definitely what I see here, but I also understand the context, some of the volatility that's got us to this point. Neutral for me. I think Matt still got a slight bear lean, if I do, remembering our conversations correctly. Ty, what about you? What are you seeing here?
Yeah, slight bear lean, but I mean, come on, that was a pretty impressive bounce.
It is. It is a very slight. You got to navigate the bear retracement. You got to get above moving averages. I'm sorry. Right. You got to be technically consistent. Agree, Tyler? You are the master
I agree.
technician.
I agree.
And so slight bearish lean. Personally, I like gold, but you got to have a slight bearish lean when you're in a bearish retracement. Until that right shoulder gets just absolutely blasted and we get bear stop out day, which could occur here. You gotta have a slight bearish lean based on technical.
Well, and the thing that supports that too, gold stocks look like garbage right now. GDX just looks nasty. Silver doesn't look good either. So it's that whole space is just a mess right now.
The thing I want to talk about with gold is not about gold today. It's about Palantir. So bring up PLTR right now if you can. I think this is a really cool and interesting story.
I think this is Tim and Mark's way of trying to get me to like this company.
No, I think they're doing it on their own, bro. They're going to convince you through their own actions.
They might be. That, like, honestly, Mark's been talking to me about this stock for like 2 years.
Yeah.
And I just never listen because he has a love affair with it and he's emotional about it. And I'm just like, you're not logical about it. He might be right.
He might be right. He might be right. There's no question about that.
I was impressed by I'm impressed by some of the recent actions by their CEO.
Smart, dude. I mean, listen, here's the thing. This company is thought of as an innovative type company that's always forward thinking about the future and all that kind of stuff. What have we seen over the last year companies doing with their extra cash holdings? I mean, they invest in growth, they invest in ideas. Some of them have even been buying Bitcoin and cryptocurrency assets, and those have splashed all the headlines. Here's a company with all the growth storylines, the innovation storylines, you name it. It's a Cathie Wood darling. They bought gold, Tyler, with some of their extra cash. In fact, they're now debt-free from their quarterly filing. they announced that they are now debt free, and with the extra cash they have, spent $50 million to pick up gold, and specifically say they're concerned about current inflation. They are trying to offset that with a hedge in gold. They see gold as the better hedge for inflation directly as to what's happening in the market. And they're also preparing for a quote unquote black swan event. I find this fascinating, Tyler, that a company like this is now investing in gold directly. They're taking, and by the way, most growth stocks of this size, Matt, they go out and make new deals. They go out and flash that into new sales or new product design or whatever it is. They're taking a little bit of it to hedge. I like the story, Matt. You're going to end up liking this company. I can see it.
I'll tell. Yeah, I could get down with that CEO.
I have a couple thoughts.
It did pique my interest. I will tell you that it piqued my interest far more than I have been at any point when we have ever analyzed Palantir.
What do you think, Ty?
First of all, I'm like, what a boomer move.
That's right.
Did you mean Bitcoin, dude? Come on. I mean, all seriousness though, I don't know. I guess companies have always tried to be strategic with their assets and cash on hand. Are we going to get to the point where this is a new trend and companies that have cash, instead of doing the traditional R&D acquisitions, let's become a mini hedge fund, and let's see how strategic we could be? It's like, I don't know. Do I want the CEO making directional bets on precious metals? I don't know.
You do not. You don't want to making bets. Neither do you want corporations becoming little mini hedge funds, because it's fantastic in a bull market. Leverage on leverage gets you wiped out from a country. You don't want that. It's good in good times. It will wipe out your economic system. No, we don't want that.
I don't know if I see it that way with this story, though. I mean, are they really making a
speculative?
Yeah, I know.
I was talking, we don't want every corporation to be Berkshire.
And I'm thinking through what Tyler's trying to prevent. Yeah. I mean, here's the thing. Palantir is probably dealing with the same problem every one of us individually are dealing with. You've got cash. Yeah. What do you do with it, right? And if first of all, you better have enough cash to execute your balance sheet, to execute your, expenses, all that kind of stuff. But if the CFO is looking at a pile of cash in a company and they say, I think we should put 2% of it in gold for a hedge, I see that maybe as a responsible act. I don't know. I'm going to have to think through that, Ty.
Was it 2%?
It's $50 million. I just use that as an example. Don't quote me on that percentage, because I don't know that.
Because that's the thing, right? Like, maybe we should just all agree that if it's less than 3% of their cash, this is a eye grabbing headline that is much ado about nothing.
I 100% I agree with that. But to go back to Tim's percentage conversation we were having, don't we want our corporations investing back into their business, investing back into their people, giving wage increases, giving benefits to their people, providing healthcare to their people, and not investing in Bitcoin and not investing in asset classes? Like, isn't that why we invest in them?
I agree. But what if they do both? Because I know they've hired like 350 sales guys or something as well. I mean,
when you prioritize one has to take a step back.
That's a fair point.
Nobody has it all except Apple and Microsoft.
I was about to say, I don't know. Apple's got so much money.
Yeah. Like, Apple's different. Apple's different. Apple's a country though. They got the GDP of like England. We're good.
All right, so I got the numbers here. They got 2.3 billion in cash. They put 50 million in gold. So what is that percentage? 2.5%, something like that. Cool story though. I thought it grabbed my attention, no question about it, here today. And they did say, we are considering Bitcoin, but they didn't go out and buy Bitcoin first as that hedge. I think there might be a lesson there as well for their personal view of it. But let's move on. Let's move on to Bitcoin analysis next. Crypto markets.
See, and I think Mark and Tim just found the one headline they got to be able to convince me to like this company.
It's going to open you up, bro. It's a long-term process with a stock like this.
I'm still in the I don't trust you on this. No, I kid.
Technicals are improving though, don't you think, guys?
I do think the technicals are improving here. I did like their earnings report from last week as well. I thought it was a positive earnings report, broke back up above. I think the interesting technical environment here will be the weekly breakout. But again, you don't get to a great weekly breakout unless the daily starts shoring up. The daily's starting to shore up. That weekly channel, Tyler, if you want to give it a number, I'll trust your number. Was it 27 and a half? Somewhere in
Yeah.
that ballpark.
Yeah.
I think that's your number you're really looking at from a potential breakout. But yes, the daily chart is starting to improve.
Daily's starting to look pretty good. All right. Very good. All right. Let's go on to Bitcoin next. Let's keep moving through the market. I do want to get to earnings roundup because Target and Lowe's, two big retail names did report. Want to hear, the numbers of what Matt's take is. It's some interesting price responses in those two stocks as well.
Tyler's lines. Look at those. They're so pretty. Tyler, is this just one of the moments you don't even say a word and just let the picture do all the talking?
I've already checked out.
I know you have.
In all seriousness, though, if this thing does break out on this line, like, I'm just retiring. I'm out of here. See you later, boys.
No, you won't.
No, but the fact that it, for those that don't know the backstory here, the last two times Bitcoin's run up to resistance, we've kind of mapped out potential scenarios, and I picked high base in both because it's the most bullish type of consolidation. And in fairness to Bitcoin, look, I mean, could you have asked for anything more as a way of digesting the supply at 47K? I mean, it's doing pretty well, and I love that it didn't go on the first attempt, because I drew two zigzags, not one. So
I want you to go with that for a second, because you've said this many, many times when I'm, analyzing stocks or charts with you. You and Matt talk about how it has to digest supply, how it has to get the sellers out there and all that kind of stuff. And I think it's a very important point, because many times I think new traders just want their stock to go to the moon. But if you truly are holding on to Bitcoin, consolidation and letting the sellers get a chance to get out while you're still holding price is actually very, very healthy. Tyler, is that what your point is?
Yeah, you want to scare the bears.
Yeah.
Yeah, it's like, I don't know, there's a lot of analogies, but it's just changing hands, right? So every time somebody wants to exit, there's somebody else coming right back in. There's an equal amount of supply and demand at the same price. That's healthier because you have new buyers coming in. If you didn't have that and everybody was bailing, prices would drop to find new buyers. So the fact that it can churn up here just tells you there's this persistent demand underneath the surface, enough so that it's absorbing any selling pressure coming in. And that's constructive, because presumably you eventually chew through the supply. Like, eventually everybody who wanted to bail at 47 has bailed, and all else equal, demand stays constant. Now we push higher. We're just waiting for those weak hands to get washed out, and then the thing goes higher.
Yeah, I think it does a couple of different things, and I 100% agree with Tyler. Number one, the stabilization you have at the top of the chart gives people a little bit more confidence in pushing forward, as you, especially as you don't see volatility, right? You'll start to see people see it as a little bit more stable. Number two, when you want to see that blast off, you want to see the utter destruction of the bearish analysis. And so you want to see those moments in time where the bears can just get tricked in, and then just get blasted. And so you see a couple times over the last week where you see those big down days, right? Big down days, but they get gobbled up. Do you have any appetite to short Bitcoin?
Not a chance in the world.
Okay. What do you think of the other sellers on Bitcoin are saying?
I don't think people are shorting right now.
They're looking somewhere else, aren't they? So they're kind of going away. The stability is starting to solidify itself, and then the technicians come in, because the fundamentalists are always there on Bitcoin. They never leave this product, right?
That's correct.
But the technicians come back in and they say, now we like the stabilization. We like the triggers. It can hold its head above the water. We're not going to see the volatility. They can unleash the algorithms and the trades above those resistance pivots as well. Confidence levels start to build. Confidence leads to price appreciation, in my opinion.
Love it. Yeah. And I don't think there is a single bear out there who's shorting right now. I'm with you, Matt. I think this is just,
They
exactly what
tried.
you guys are
They
talking
got
about.
blasted.
Well, some of them won there for a bit if they were very short term when it was back in the summer, right? I mean, but I'm not.
Well, we're talking about
that
now,
side.
though.
Yeah, I'm with you. All right, very good. Let's now move on into stock talk. And Matt, really a very simple round of stock talk here today. Got a couple of earnings
We're
round
gonna be
up.
quick. We'll be quick. I want to get
Yeah.
into Jedi options here. Let's start with. Let's go good. Let's start good today. Let's go to TJ Maxx here. TJ Maxx had a very good earnings report that came in at 79 cents versus the expectation of 58. Revenue was very impressive at 12.1 billion versus the 10.9 expectation. Revenue went up a whopping 81.1%. You're seeing a market gap up, run up, and then break out here. Tyler, on the backs of some very positive numbers coming out of TJX here this morning, what is your technical read?
Yeah, I will tell you just up front that some of these retail stocks are tricky to trade. They just don't have that great of trending characteristics. I think TJX over the long run kind of shares that. But that said, I mean, in the short run, credit where credit's due. This thing has been carving out some higher highs, higher lows. And Matt, it had a nice little 4-bar retracement right into earnings. So technically, it's behaved quite well over the last couple of weeks. When you look at it on the weekly chart, you're towards the upper end of its recent range. The next trade is a breakout over 75 bucks and change. So ideally, this pulls a Bitcoin, runs up to 74.5, chops sideways, and gives me a nice little breakout.
Yeah, I like it. TJX is not exactly a trader's stock, right? I can't remember the last real good technical setup on it. But I could see something developing under right there underneath 75. But again, that's going to take a little bit of time. From a raw numbers perspective, any investor has to be satisfied here, like any investor does. These are some pretty decent numbers coming out of TJX this morning. Let's shift a little bit to Target here, TGT. Darling, everybody loves Target. I know Tackle Trading loves Target. We love Target. It's been on many of our lists over the years. Target comes in at 364 versus 348. Revenue came in slightly above the expectation, 25.2 versus 24.8 billion. Revenue went up 9.5% year over year. An extremely lukewarm, very boring numbers coming out of Target this morning. Had a pretty good quarter overall. What's your technical read as we test the 50-day moving average for the first time in the quarter?
You know, the thought that came to mind when you're talking about this is, are we going to treat Target now like we treat big sell-offs in Walmart and Costco, where you're like, you're just an idiot if you don't buy this thing?
I think so.
So the hope then is that this gets smushed. I mean, this Target's gone up an insane amount. And it always gets to the point where it gets too far out over its skis. They priced in all the good news, and maybe the growth is good but not great, or great but not fantastic, which is what was priced in. And then you get a little reset. Good. I mean, was anybody here super excited about chasing this up at 267 anyways?
Nope.
You want a shaking of the trees. I wouldn't mind this getting whacked a little bit more. What I have in my head, which is maybe just too wishful thinking, you look at Walmart, which got destroyed in the first quarter and was a great long-term buying opportunity. Costco, in hindsight, it's like, oh my gosh, duh, you should have bought the crap out of this at 300. Maybe something similar. Probably doesn't go down as much as those did, but
no, I don't think they do either. But maybe if you put that on the weekly chart,
I was just looking at the weekly. Yeah,
maybe we see a test of that 20 weekly. Yeah, that's kind of where my head's at. Maybe a little deeper retracement. If you don't get it, you don't get it, right? There's a lot of fish in the sea to trade. But I think that's where I personally would be interested. Maybe not the double top, double bottom scenario that we saw at the first of the year, but some orderly retracement coming into the weekly 20.
Wouldn't mind that. I would prefer patience on this versus buying the first dip, particularly in light of how the market looks right now.
Yep, I agree 100%. Let's go to Lowe's on the backs of Home Depot yesterday, missing a little bit of beat on Home Depot, but some guidance concerns on Home Depot. Lowe's comes in at $4.25 versus $3.99 on the expectation, 27.6 versus 26.7 billion on the expectation for revenue. So a slight official beat on revenue and on EPS numbers. Revenue did go up 1% year over year, which was about in line with the expectation. They did have a same store sales miss from a quarterly perspective, hit their number on a yearly perspective. Very mixed read out of Lowe's here today. Market, however, is not mixed. Market's firing off. I got the market firing off on a very mixed report. And Tim, you know this about me because I say it all the time. When I see numbers like this and I see a market firing off, it causes some confusion because somebody had to say something. What do you got?
Well, here's what I got. If you go down to the 5-minute chart, I was going through this because we both had a head scratcher this morning. It's like, okay.
But it's just like they fired off and ran on this report and it just didn't make sense to me.
If you look at where the price response is, they've initially had a nice little bump when the earnings numbers came out. The conference call started, from what I understand, CFO, COO, and CEO all talking about forward guidance in their revenue. They had some positive things to say about 2022 and how much more revenue they're going to come in at. I think 92 billion up from 86 and all that kind of stuff.
Isn't it amazing when all you have to do is say things and not do things to get price? I mean, that's
people believe you. Yeah,
that's some Dark Knight type power there. But they had to say something positive because whatever they said last year, they didn't do that. So maybe they'll do it next year. I guess that's the hope, right?
These aren't the droids you're looking for.
No, they're not. No, they are not. Okay, so they said something positive and people bought it up. Fantastic.
Yep.
All right, let's move on to ADI, analog device here. ADI comes in at 172 versus 161. Beat on EPS numbers. Revenue came in at 1.8 versus 1.9. That resulted in a 20.8% increase in revenue. Decent numbers, fine, passable numbers. Tyler, what do you see technically? Tough wicks, tough trend, tough gap, tough everything. I don't say anything.
This is a semiconductor too, right?
Mm-hmm. That's why I brought it up. That's
so the other tough thing is there's so many really fun stocks that trade in the space that make something messy like this.
Would ADI make the top 20? And
that's a good question.
I don't know if they would.
I don't know. It might. 20 is a big list.
It's a big list.
Would it make the top 100 in the semiconductor industry?
Listen, if you don't think I won't go find that darling out of Israel, I will find a better than analog device. But no, I don't know if it would make the top 20. I just brought it up because it is semiconductor and obviously the importance to the sector. But outside of that's earnings roundup for today.
Very good. Appreciate it as always, Coach Matt. Now let's move into our last segment here today, and it's going to be called Jedi Options. This is something we started probably 2-3 months ago, I think beginning of the summer, something like that, Tyler, and I really, really love it. One of the strengths you have as an educator, as a coach, as a trader yourself is in the options market. I mean, you go in, you understand implied volatility curves, you know how to build these different strategies, and you really know how to teach them. And so what Tyler does each and every Wednesday, if you're brand new to our channel, is he goes deeper into some kind of strategy or idea in the options market, kind of helps us understand it and gives us some ideas as well that might be tradable. So Tyler, what do you got here today planned for us?
Yeah, so I'm going to do just a quick little lesson on a bull call spread strategy. And then I'm going to show a stock that I think is an appropriate example, good case study of a pattern that I think lends itself well to this particular strategy. And specifically, I'm going to explain why we like the bull call, because originally we were thinking maybe covered calls, but stumbled upon this particular stock and thought it was a good example to present and say, hey, this is a scenario where even though I love cash flow and I prefer the higher probability stuff, if I ever were to get a little more directional, a little more aggressive, it's going to be with this type of setup. So that's where we're at today. So I'm going to pull open, I'm going to take a few notes. All right. Going to take a few notes here. I think it's good to be organized. There's a couple of different ways to explain a bull call spread, and it has a couple different names as well. So you got a few different names that you could use. You'll hear this referred to as a bull call spread. It's also known as a long call vertical spread, or you're buying a call vertical spread. And it's actually a very simple strategy if you already understand how to buy a call option, right? So step one is, oh, and by the way, your bias when you do this, you're like moderately to aggressively bullish. Okay, this is not mildly bullish. We're expecting a pretty nice move in the stock. So I want to swing for the fence, but I'm not crazy. Like, I'm not going to straight buy a call. I'm not like mega bullish, like in between. So moderately to aggressively bullish. And I would love if options are a little cheaper. So low implied volatility signifies that options are a little bit cheaper. This is a debit spread. I'm paying to get in this trade. The cheaper the options, the less I'm going to have to pay. So that's kind of the bias. Okay, so the structure, the first thing you're going to do, and that's how I would explain this, is just step one, step two. Step one is you're going to buy a call option. You're bullish enough to buy a call because you think the stock's going higher and calls are somewhat cheap. And you could stick with that. You could just straight buy a call. You have unlimited reward. But you're paying a decent amount, even though it's cheap, you're still just straight buying option. So you got to pay a little bit. If you wanted to reduce the cost, you could sell something against that call option. The other reason why you might want to sell something against the call option and create a spread is because of time decay. When you buy a call, you're fighting theta, you have a negative theta position. So time decay is hurting you. You're also quite sensitive to changes in implied volatility. So if you want to mute your exposure to both time decay and volatility, you turn this into a spread. And so step two is we're going to sell a call option against the one we purchased. And specifically, because you got a lot of different calls to choose from, you're going to buy a lower strike call option. Okay, lower strike. Usually it's around at the money. Okay, so lower strike, comma, near the money is what we're going to say. Going to be close to at the money, maybe a little in the money, maybe a little out of the money, but right around the current stock price. And then you're going to sell a higher strike call, and it's going to be out of the money, right? Out of the money, call option against the one you purchased. Okay. And so say I buy a call for $5, sell one against it for $2, that reduces my overall cost to only $3. So instead of paying $5 and having $5 of risk, I now have $3 of risk. So these are easier trades to actually not need a stop loss on. If you can structure this cheap enough, doesn't matter if the stock blows up, you just lose a little bit of money, which is another, I think, perk for this type of strategy. So that's the basic idea. Let's build one, and let me set the stage with this particular stock. So at Tackle Trading, we have a list of stocks that are usually prime candidates for covered calls. We like the fundamentals. They have good options available. The call premiums are decent. So I was where this stock came from was the Tackle 25 list, but a little bit of backstory as to how it might have got onto my radar. One of the things I like to do on a daily basis is look at my watch list, both stocks and ETFs, sort by percent change, and see what's moving, right? What's moving. And one of the stocks that I saw was moving today up 7.5% was United States Steel. And I know that stocks, especially steel stocks, basic material stocks, they're sensitive to what's going on in their sector and industry. So I thought, oh, steel stocks are moving today, which is nice because they got beat up a little bit yesterday. So I wanted to look at steel stocks. So I went over the Tackle 25 list, and the steel company on that list is Steel Dynamics. STLD. So I say, oh, okay, so Steel Dynamics is up today. It's green. And not only is it up today, because really screw one day's performance. I mean, what does that tell me? I want a good trend. So Steel Dynamics, again, not only does it have a good bar today, it's got a lovely little trend. I mean, take a look at this nice little high base here. Actually, more than a high base. This is more of a trading range, multi-month trading range. You get a little breakout right here. Got a little breakout on high volume, showing institutions coming into the fray. On the news and kind of context backstory for steel stocks, you've got an infrastructure bill that's in the works right now. I think that has renewed interest in steel companies. If you missed the breakout 4 days ago, you're like, oh, that sucks. I missed it. Please, Mr. Steel Dynamics, come back. Give me a buy the dip setup. Come back towards this 67 level. Maybe old resistance becomes new support. Steel Dynamics is like, yeah, you got it, man. Here you go. I'll give you a little multi-bar pullback, 3 days down. There you go. Well, what more could you want? Like, that's exactly what you wanted for. So you got a lovely little bull retracement after a big breakout. Weekly chart also looks delightful. Really good breakout last week. Little inside bar for this week, showing you're digesting the move. It's healthy. It's healthy. And so why not do a covered call? You could do a cover call here. I don't mind a cover call. The question is, how bullish are you? And which strategy do you think is going to best suit your bias? If you're mildly bullish, sure, do a cover call. But this is a pretty sexy setup. It's in a really good sector and industry particularly. Steel stocks are hot right now. If ever there was a time to go a little more directional as a cash flow trader, it would be something like this. It would be something like this. And so perhaps the bull call spread is more appropriate, gives you a better risk reward than just settling with a covered call. Because by the way, if I was going to sell a covered call, I'd be buying the stock and selling like a September 75 strike. And when you run the numbers, it's around a 10% return, which is pretty good for a covered call. It's really good for a covered call, actually. But I'm a greedy bugger, and I like the setup. It's one of the better charts in the market. Looks nothing like that poor Russell 2000, right? Looks better than the S&P. You got relative strength here. So, I don't think you can find a better pick, quite frankly, from a setup perspective. Now, whether or not it works, we'll see, but maybe worth me opening up the risk graph and having more than a potential 10% return. That's the motivation for the bull call. When you look at the options implied volatility, it's not particularly low, but one of the things you'll discover about IV is it's one variable. It's not the end all be all. I can still structure a pretty compelling bull call spread, even though the vol might be a touch higher than what I would like on paper. Okay. But we'll find out. I build the strategy and I see what the numbers look like. And that in turn kind of tells you if the little bit higher IV was a deal breaker. So essentially what I'm going to do is I'm going to buy an at the money call. I'm going to buy the 70 strike call option. Hoping the thing goes up to 75, 80, 85, hopefully $100. I want it to go up a lot. And from a month perspective, I got lots of choices here. September, November, January. If you do a really long-term call spread, it's going to be like watching paint dry. It won't move very quickly. Obviously, I can't do August because there's only 2 days. And I don't want to watch paint dry. So I don't want to do like a 6-month bull call. Okay. October would be the sweet spot for me, a little 2-month bull call spread. I'm like, I want resolution relatively quick. And I think if I'm wrong, I'm going to get out. And so I'm actually going to do September because I think it's a little more aggressive. But honestly, what would help me make the decision though is to build the trade out in 2 different months and see what I think. So let's start with September. Maybe I'll change my mind. We'll see. I want to buy the 70 call right here. Okay. It's going to cost me about $3.50. And I could be done, by the way. I could just say, look, Steel, I love you. I'm just going to buy a call, go to the moon, make me happy. You could just buy a straight call, but you got to pay $350. So the appeal and the carrot, right? The incentive of selling that higher strike against it is you reduce the cost. Now, if I'm going to do this for September, I don't know that I want to sell the 80 call for 60 cents because that doesn't reduce my cost that much. If you do September, I think I'm going to have to do a 70-75 bull call. So buy the 70, sell the 75. That would cut the cost like in half. Now I'm paying $1.85 for a $5 spread. The delta difference between the two is about 22. That would be my net delta, about 22. I don't mind that trade. And it only requires Steel Dynamics to get up to 75, which is completely doable in the next 30 days. The only other consideration or alternative I might entertain is going out to November, giving it a little bit more time. And if that were the case, I'd probably widen the spread. I'd still buy the 70 strike, but I'd sell the 80 against it. you're paying about $3.50 and you're shooting for a $10 wide spread. So risking 3.5 to make 6.5 instead of risking $1.85 to make 3.15. That would give you more potential upside, although it's a little bit more expensive. Your net delta is also pretty good on that. 53 and 29, you got about 24 net delta. If I'm doing my math right. I like either one of those. I think they're both checking most of the boxes here. Tim, I could get into the risk graph here in a second if you want, but that is my initial kind of intro to the bull call.
You know, I was just sitting back watching. I loved that what you just did there. I want you to go back to the trade tab if you can for just a minute, because I do have a couple of thoughts. And thank you, Tyler, number one, for walking us through the technical pattern as to why you liked it, going through the whole process there, and then building out the spread. To me, the November is the choice. I understand your instinct to go to September because of your management skills, right? And because you're going to be micromanaging this as a short-term trade based on technicals, trigger points, step system type of principles, right?
Yep.
I think I want to have a little bit more time. And one of the reasons I want a little bit more time is when I'm in a spread, $70 is the anchor strike itself. And so you actually are, and you know this, we're carrying time decay on the 70. It's not a lot, but you are carrying time decay on 70. Since it's right at the money, you're essentially buying a bear call spread somebody's selling to you. They're capturing a 30-day time decay trade, and you're betting on the upside with delta and that you're going to offset theta. I'll just take the balance because I agree. I would not go out to January, and I understand why a trader might use September here, but I would take the balance of November to where I still get the delta I want. I can open it up to a 10-point spread, which for me personally allows me to kind of manage it a little bit more like that $10 target that I might be looking at. I mean, the stock can fly, you know, if it wants to. If that chart technically confirms, I kind of want the upside. And as a percentage of the spread, if you look at this, $1.80 against 5 is not cheaper than 340 against 10, right? Because if you flip that to 2 contracts, you're still basically paying the same amount of money for the 5 versus the 10. I'd go November. I'd choose that one. I love the conversation though. And I think it always does really help any new student out there in the options market when you compare one against the other in a very similar vein and talk about those subtleties, right?
Yeah, I mean, when you first learn a strategy, it's like, look, I just need to know, like, what are the base rules? Just tell me, you know, how to build the thing. Forget the why. Just tell me how, so I can like get this under my belt. But then once you understand how to build a bull call and what it is, then this is like level 2 of your understanding, where you say, okay, now look, you understand the basic idea. Now let me help you understand why that's the default. And if you were to deviate, if you were to do a September bull call versus November, you know, this is the implication, right? This is the trade-off. And this is why options are both complicated, but fun, because there's a million different ways you can structure it. And the key from the educator standpoint is, I don't care what decision you make. I just want you to make an informed decision and understand why you did it. And as long as you understand the why and you're comfortable and you like the trade-off, that's fine. Like, there is no right way of doing it to a certain extent. So your logic is sound on the November. I have no problem with that. Yeah.
Matt, any thoughts on this STLD bull call directional play that Tyler's been mapping out?
Yeah, a couple things. Number one, love the setup on STLD on both the weekly and the daily time frame. You gotta love the weekly channel breakout, and then the bullish retracement that's fighting for some confirmation here. It's in a good zone from a technical perspective, and when you're looking at whether you're a positive 1 or a positive 2 technical bias, a bull call spread certainly does fit from a technical perspective. So that's number one. I just want to say more than anything, though, is thank you for the conversation, guys. Really thoroughly enjoyed the discussion between the 2 time frames, September versus October, and why both of you guys like the one or the other. I think it was very fruitful for a lot of people. So just thank you for the conversation. I
appreciate that. Hopefully people got value out of it. I love this segment, Tyler, and great job on STLD here today and mapping that out. If you want more education on bull call spreads, I would recommend checking out, the playbook at Tackle Trading would be a great place to start, or to jump in Tyler's trading lab, which he holds each and every Wednesday. Actually, you'll be holding that here in about an hour and 20 minutes. You cover topics like this quite often, right, Ty?
Indeed. It's, might I say, the best hour of your week. I mean, you should come join. You'll like it a lot.
The best hour of my week. I think Trading Labs could be up there, but I like the scouting report meetings a lot, bro. There's a couple of competition. Trade Masters
Don't think
is so
too much
much
about
fun.
it, Tim.
All right.
It's right. I feel confident.
All right, let's start wrapping up the show. Back on the S&P 500. Let's get final thoughts. Talk about kind of some programming notes through the day, as well as just kind of what to pay attention to. 18 minutes. The Fed minutes will come out. We'll see if there's any market response. Analyze it tomorrow if there is. Matt, final thoughts from you, sir.
You asked me earlier today when the last time I actually cared about the Fed minutes. I could not remember, and neither do I care about this one. However, with any economic report, especially in heightened technical environments, they take on greater meaning. So yes, stick with us tomorrow. But again, it's a Fed minutes report.
I agree. Tyler, any final thoughts from you, sir?
Listen, we were down 0.21% earlier today when we started. We're now only down
0.19%. We helped.
Market's got a little bit of a tailwind going into this Fed meeting, feeling pretty good about the
feeling confident
here.
Feeling confident.
Oh, goodness. Upward ticks. I like it. My final thoughts are very simple here, guys. Keep it simple in the marketplace. I mean, the S&P is not that, ultimate end all and be all for everything happening out there. I know some positions are down this week, especially if you're in energy cyclical areas. Focus on your trading rules. Keep building out your trading acumen with these strategy conversations, learning about them, stuff like that. And there's always opportunity shaping up. I'm really excited about what's going on in some of those cyclical sectors, Matt, like you highlighted earlier. So there's a lot of opportunities moving forward. Just keep an eye on it. We'll be back to break it down each and every day. We're back tomorrow, but tonight we have another round of our Trade Masters with Coach Mark. If you are a fan of tackle trading, if you are hashtag Team Tackle, come join us live and see these two coaches battle it out head to head. See who can bring home the title. I think Emily won last week, if I remember right, Tyler. Is that right?
I can't remember. I forgot.
I think so. 7 o'clock Eastern Standard Time. Emily will be defending it. We'll see everybody there at that time. Until